We were chatting a lot about Lemonade maybe 2 months ago as it did the incredible run up from 17, 18 to 53, I think was about the local high. And then it fell back down to the 31 or so dollar range. So yeah, we haven't lost enthusiasm along the way. We know most of our viewers are Tesla bulls and maybe don't love hearing about Lemonade as much, but we are still very bullish on the stock. And even though we did do a pretty significant trim for our clients as it ran up, we didn't lose confidence. And in fact, we upped our base case. So our previous base case valuation was $83 per share. That was when it was trading about $17 per share. After we got some new information on the Q3 results and the investor day, we raised our base case up to around $100 per share. But then we looked at another case of if management just does what they said they do. And the valuation we were coming up there was about $130 per share. So we still think that there is a kind of silly amount of upside with the stock trading around $38, $39 right now. But yeah, it has recovered nicely from the kind of local low that it hit, and now it's rallying into earnings next week. I'm very much looking forward to Lemonade's earnings next week. I think that one of the reasons the stock got hit pretty hard, part of it was just, I think, a little bit of retracement after what was a kind of insane rally going up 3x in a month and a half. It's not surprising that there'd be some consolidation after that. But then they got hit with concern around the California fires as well. So my suspicion after digging into this for a while is that they're going to have a very strong Q4 report, better loss ratios than they've had in a long time is my expectation. I won't get into all the reasons for that right now, but we do think they're going to surprise, and that might further diminish the bear case. And then we do expect them to address the wildfires in California, and basically that gives some indication that it'll be a very minimal impact to Q1. So if that happens, then we think that could give some further kind of juice to, I don't want to say that there'll be a squeeze, but give some further, I was going to say fuel to the fire, but that's almost a worse analogy given the Palisade situation. But we think that might help give the rally some additional legs. And one of the things that is just always hiding in the background is the fact that the short interest is so high. And that's something that I know you've been taking a look at. So what's your thought when you're looking at short interest on the back of these potential catalysts that we're seeing going into earnings?
Yeah, I don't know if suddenly there'll be a squeeze. Short interest is 30% of the shares roughly, which is really high. Tesla in 2019, the short interest was over 30%, I believe, or right around that. In November, Jim Chanos, he asked me a question on X, and I believe he's short Lemonade based off of his comments, but he may not be. And he asked me, what is Lemonade, and we'll break this down, what is Lemonade's combined ratio, X, their cost of acquiring new customers? It's called CAC. And so I did a little math, and I found that in the 9 months ending, and he provided me all the numbers I needed to do the calculation, which was so funny.
Just do it yourself, Jim.
I could have said that, but I did it for him. Their combined ratio was ex-CAC was 140%, ending Q3 2023, and all the way down to 120 in the 9 months ending Q3 2024. So there's a clear trend. And I think at some point it was like way above 160, their combined ratio. Was it ever above 200%?
Probably, yeah.
Essentially, you want it like 80% or lower, I think. That's what a good insurer would be over time. So there's a clear trend in Lemonade's combined ratio. And if they have the quarter that we think they could, their combined ratio could get under 110% this quarter.
And importantly, that's excluding customer acquisition cost. Yeah. And a lot of the bears or the naysayers out there will say, oh, you're just like excluding random things and making up your own metrics. So why is it important to exclude customer acquisition cost at this point in the analysis of Lemonade?
Oh, you put me on the spot, even though you're the numbers guy. So when you choose to acquire customers, it's a free choice you're making, and you're essentially going out into the market, you're spending money on ads, and you're trying to acquire new customers. And so it's an investment you're making in new customers. So it's a choice that Lemonade's making, but it's also a choice that all insurers make when they're choosing to do advertisements or find new people online. And For whatever reason, like all these Wall Street analysts have forgotten that this is the case. So right now, Lemonade's costs are pretty flat. They like grow slightly. So like their operating expenses X these customer acquisition costs grew at 2% over the last couple of years, while their revenues grew at 50%.
I was worried you were going to give the hail there. Don't do the hail.
So right now it's like this, where they're losing money. So it looks like that. And eventually they're going to be making money. And I think they're at a similar place to where Tesla was in 2018, where Tesla was only making cars in Fremont. They needed to expand. Fremont, they couldn't make more cars at Fremont, at least at the time they felt they couldn't. They needed to expand or they were going to die. They were essentially losing $900 million a year. But we could go and watch drone videos of Tesla putting up the Shanghai factory. So we think Lemonade is a similar situation where we can see the overall growth. We can see them purposely spending money on advertising and marketing. And we can see that their insurance business, just at the insurance factory level, is gross margin positive, just like Fremont before they expanded into Shanghai was gross margin positive.
Yeah, and maybe where the analogy breaks down a little bit is that when Lemonade or when Tesla is expanding a factory or building like the Shanghai plant, that from an accounting perspective, all those dollars that they're spending to build a new plant, that goes into capital expenditure. So it doesn't hit as an expense line item. It goes onto the balance sheet and then is depreciated off over time. For a company like Lemonade, they don't have that. So as they're trying
they don't
to
have that
build
luxury.
they don't have that luxury. So they take the entire hit when they acquire a new customer up front. They take that entire like CapEx type of spend up front as they acquire a new customer, but then they get those customer economics all the way into the future. So it's almost the opposite, like where a manufacturing company like Tesla, you take the hit up front and then you take the pain over time, or you don't take the hit up front, but you take the pain over time on your spending. For Lemonade, you take the entire hit up front, but then you get the benefits over time. So that's why looking at it, excluding customer acquisition cost or ex-CAC, really makes a lot of sense to really understand what they're doing. And really importantly, if we didn't have a lot of confidence around how good their customer economics would be, then we wouldn't be so hot on this company. But we have multiple sources indicating that their their IRR or their ROI essentially for, I think it's IRR, for their new customers that they're adding is in like the 50% range. And then they're levering that up with debt such that the capital that Lemonade is actually paying for these customer acquisitions is like a triple digit IRR, which for anyone who knows finance, like that's insane.
Triple digit means 100% or higher internal rate of return.
Yeah, which is just completely crazy. But like they've been saying this for years. They've got, and then they actually dropped.
They showed the math. They've proven it out.
And they actually provided an Excel spreadsheet to all the analysts on Investor Day, which was hilarious because we've known this for a while and have tested it. And we built our entire model with this understanding, which is, I think, different than other people who've analyzed it have. So you basically layer in these cohorts over time that have these triple digit IRRs essentially. And when you do that, it actually gives you really good indications of what the future is going to look like. So our model's been very accurate. And then on top of that, we have General Catalyst, who is actually financing against this. And they're looking at all these customer economics. And so in my mind, it's like having a third party referee basically saying, yeah, like these customer economics that management is telling you, they're actually legitimate because we're lending against them. And they're putting out all these statements publicly. And that would be fraud if this was not actually the economics that they're seeing. For them to be spending tens of millions of dollars right now on very high IRR projects, when you start doing the math of what that indicates in the future, like combined with the fixed cost that they have, but the improvement to the operating leverage in the later years, it's just like you're gonna get to this point, and then at that point when you're highly profitable and you're a bit more mature, then it's going to make a lot more sense to look at combined ratio and book value and all these kind of more traditional metrics that the legacy insurance companies and analysts would look at to evaluate a company. But when the company has negative net income right now and it has a negative combined ratio, obviously, like you can't look at it the way that you would these other companies that have been around for 100 years. So that's my rant. Sorry.
That's awesome.